Padini Holding is a well-known fashion retail company in Malaysia. Their main focus is on designing, producing and selling stylish, affordable clothing, shoes and accessories for men, women and children. They own several popular brands such as Padini, Vinci, Sid, PDI and Mickey Kids, each offering different styles from office wear to casual outfits and kids clothing. All these brands are usually found in Padini concept store where customer can shop everything in one place. In short, Padini business is all about making fashion accessible to Malaysians, offering trendy items at reasonable price while staying up to date with the latest style.
Bonia Corporation Berhad established in 1974 and founded by Chiang Sang-Seng. Company has grown from local leather workshop to an internationally recognized name. Bonia Corporation Berhad also operating across Malaysia, Singapore, Indonesia and more. The company offer high quality leather goods, apparel, footwear and accessories. Bonia Corporation Berhad also offering products like handbags, wallets, shoes, watch and franchise.
Comparison for Padini and Bonia current ratio is in 2022, Bonia show higher ratio 2.76 times compared to Padini 1.50 times. However, in 2023, Padini show higher 4.09 times ratio than Bonia 2.80 times. By 2024, both company record the same ratio of 3.11 times. Ratio, Padini rose from 1.08 times in 2022 to 3.23 times in 2024, showing strong improvement in liquidity. Bonia start higher at 2.6 times but dropped to 1.80 times in 2023. Then recovered to 2.14 times in 2024. For the debt to equity ratio for Padini and Bonia in 3 years is from 2022 to 2024. Both Padini and Bonia maintain low debt to equity ratio. So Padini ratio remains stable, increased slightly from 3.68% in 2022 to 4.04% in 2024. Similar for Bonia, its ratio show a slight increase from 2.94% to 3.12% over the same period.
From 2022 to 2024, Bonia Corporation Berhad consistently showed a lower debt ratio compared to Padini Holdings, indicating a more stable financial structure. For example, in 2022, Padini's debt ratio was 4.04%, while Bonia was 3.44%. The trend continued in 2023 with Padini at 3.76% and Bonia slightly lower at 3.43%. By 2024, Padini's debt ratio increased to 3.93%, whereas Bonia reduced its ratio to 3.24%. Between 2022 and 2034, Padini Holdings consistently showed stronger interest coverage compared to Bonia Corporation Berhad. In 2022, Padini's DIE ratio was 55.18 times, showing its ability to comfortably cover interest expenses, while Bonia's ratio was 20.92 times. Although Padini's DIE dropped to 15.58 times in 2023, it was still higher than Bonia's 20.79 times. In 2024, Padini's ratio improved to 28.48 times, while Bonia declined significantly to 5.19 times.
For the gross profit margin to 2022 until 2024, Bonia Corporation Berhad consistently had higher gross profit margin than Padini Holding. So we can see on the graph. So this means Bonia managed its cost of good better or could sell product at higher profit compared to Padini Holding. For the net profit margin, 2022 until 2024, net profit margin shows how much profit is made after all costs. So from the graph, we can see Bonia was stronger in 2022 and 2024, but it dropped in 2023. So for the conclusion, Bonia had better long-term profitability, but Padini Holding had a strong in 2023.
In 2022, Bonia outperformed Padini with a higher ROA of 8.14% compared to Padini 5.10%, indicating more effective use of assets. However, in 2023, Padini saw a significant improvement, jumping to 13.37%, while Bonia ROA dropped to 5.59%, suggesting weaker asset performance or declining profit. In 2024, Padini ROA decreased to 6.29% while Bonia recovered to 9.02%. In 2022, Bonia posted a high ROE of 30.2% compared to Padini, which is 9.49%, reflecting stronger value creation for its shareholder. In 2023, Padini saw a substantial increase in ROE to 21.4% compared to Padini, which is 9.49%, reflecting stronger value creation for its shareholder. In 2023, Padini saw a substantial increase in ROE to 21.41%, surpassing Bonia, which is 14.64%, indicating improved profitability and efficient equity utilization. However, in 2024, Padini ROE declined to 10.29%, while Bonia also dipped slightly to 9.25%. Padini demonstrate a generally higher and more consistent performance, with margin peaking at 75.63% and remaining robust at 73.49%, despite a dip to 17.43%. This suggests strong operational efficiency and cost management. Conversely, Bonia shows greater volatility, with its margin ranging from 18.22% to a high of 51.24%, then declining to 24.62%, while
Padini's 0.88 times, 1.09 times, and 1.05 times during the duration of interest prove that the use of assets of Padini is stable and efficient through the above average performance. On the contrary, Bonia has contracting ratio of 0.57 average times, 0.24 times, and 0.23 times, which indicate an extreme decrease in efficiency and probable difficulties in acquiring successfulness through assets to induce sale. The contrast is so striking, showing that the Padini is more efficient in its operation and financial management of assets than Bonia. The Padini holding has a ratio that is above 1 time in several cases, at a ratio of 6.73 times, and this means that there is a high utilization of its asset at some point. Conversely, Bonia Corporation Berhad is performing rather poorly as compared to others, with the ratio recorded as between 0.90 times and 1.14 times, indicating poor utilizations of fixed assets to generate income. The discrepancy is very high and indicates that Padini has some form of investment or operation efficiencies that make it attain superior performance ratings than Bonia.
In 2022, Padini Holding recorded a much higher ratio of 5.91 times compared to Bonia 2.86 times. This means Padini sold and restocked their inventory more efficiently. In 2023, Padini ratio dropped to 2.54 times, but it was still higher than Bonia 1.75 times. Then in 2024, Padini's ratio improved again to 4.25 times, while Bonia stayed almost the same at 1.77 times. Padini showed excellent performance with 26.61 times and 27.63 times respectively, compared to Bonia 7.32 and 2.99 times. This shows Padini was much quicker at collecting payment from customer. However, in 2024, Padini's turnover dropped to 13.37 times, but it still remained much higher than Bonia's 2.88 times.
The first one is make the net profit margin and net return on asset more consistent. The oscillations in such measure indicate the effectiveness of operation implementation and management of costs. Padini could optimize stock turns and cutting on holding costs by investing in automate inventory system and AI-based demand forecasting application, thereby affecting the net profit and asset utilization positively. Second one is increase brand value of power of price. Through the use of the lifestyle branding techniques, as in the case of Bonia, although Padini is an S-market retailer, the possibility introducing sub-premium lines partnered with influencer or designer brands will help the company improve how is they regarded by buyers and firmly changing higher prices, therefore generating larger net profit margins. The third part is Padini can take moderated level of leverage to finance strategic expansion. Its debt to equity ratio and its debt ratio are very low. The debt can be used to fund store growth in expanding Asian market, digital infrastructure, modernizations, or product innovation without too large dilutions of shareholder equity. This strategic measure will help Padini Holdings Berhad to remain at the upper edge of the competitors, enhance financial stability, and dominate more market share in the dynamic retail fashion industry.
Collaborating with designer or influencers can elevate its luxury reputation. For example, Bonia's partnership with opera singer Neo of Twice has increased brand visibility and attracted new customers. In the digital space, Bonia could implement advanced online shopping tools like visual try-ons, enhancing the shopping experience and customer satisfaction. Focusing on sustainability, Bonia could introduce vegan or eco-friendly products such as cruelty-free wallets, appealing to environmentally conscious consumers and promoting innovations. Lastly, improving supply chain efficiency can reduce costs and accelerate production and delivery, ensuring faster service and boosting customer trust and satisfaction.
The first one is internal financial. Internal financial is a highly suitable option for both companies, particularly Padini Holding, which has demonstrated strong profitability and earning capacity. Padini's net profit margin peaked at 12.22% in 2023 and its returns on equity ROE reached a high of 21.41%, indicating strong financial performance. Additionally, the company times interest earned TIE ratio was consistently high, especially 28.48 times in 2024, showing strong ability to generate income above interest obligation. While Bonia's profitability is comparatively more moderate, the company still maintains decent profit margin and stable liquidity, making retained earning a viable partial funding source, especially for moderate expansion effort. The second one is debt financing. Given true low debt to equity ratio, averaging only around 3% to 4% from 2022 to 2024, both companies have the capacity to take on more debt without significantly increasing their financial risk. Bonia shows a conservative approach to leverage and a stable capital structure, which position it well to utilize term loans or revolving credit facilities to fund expansion. However, caution is advised due Bonia declining TIE ratio, which fell to 5.19 times in 2024, suggesting its earning capacity to cover interest expenses in weakening. For Padini, although it's already show high earning and liquidity moderate, use of debt could offer tax advantage and preserve international cash flow for operation, especially if expansion plans require rapid execution. Okay, like that too. So the third one is equity financial. Equity financial can be considered by both companies if they large scale or international expansion that requires significant capital investment beyond what internal or debt financing can cover. Ensuing new shares or pursuing private placement can provide a substantial cash injection without the pressure of fixed interest repayment. However, this could be balanced against the potential dilution or existing ownership and shareholder control. So, to support their respective expansion plans, it is recommended that both Padini Holdings and Bonia Corporation Berhad adopted a balanced funding approach, such as Padini Holdings should primarily leverage its retained earning, complemented by moderate debt, given its strong profitability and liquidity position. The second one is for Bonia Corporation Berhad should consider strategic use of debt financing,